joins us now. Let's connect with him. Nilesh, what a crazy March it's been. High, low, a spike in crude, gut-wrenching fall in equities. And if I look at the screen today, the shakeout in the early part of March looks like is a forgotten story.
Absolutely, Nikunj. Honestly, I mean, after a very, very long time, one has seen such an event-packed fortnight, which has just gone by, both local and global factors. What started off as a geopolitical conflict world over, the collateral damage of that basically spilled over in terms of spike in crude, spike in other commodity prices, and then of course we had elections back home here, and now of course you had the U.S. Fed. So it's been on. I mean, if I were to kind of look at a combination of different factors right across geopolitical, monetary, and political activity back home, it has been an action-packed fortnight. And clearly, in such a short span, one has seen such a big risk of kind of a trade go through. There has been, pressure across the board on different sectors, different stocks. But in a way that also created some kind of a investment opportunity for those who essentially have a long-term perspective. So yes, these were times of adversity, but it has also created times of opportunity.
So how did you use this fall? Where did you pick your spots?
Well, we've increased allocations to banks, some of the frontline banks which we've been owning in our PMS, and we increased allocations to them, given the kind of shave off that we saw in their stock prices, where we saw leading banks correct by about 25 odd percent, which I think essentially creates a good opportunity. We clearly believe that India will continue to kind of sustain high growth rates, and growth in the banking credit system, which essentially has been lacking so far, is likely to kind of inch up and perhaps get into the low double digits zone, which obviously will create a virtuous cycle of both growth, margin expansion, and earnings for private banks. Asset quality issues are behind them. So that's one pocket that we've liked. The second pocket that we've really liked in this is that, again, the life insurance space. There has been, again, a shave off of between 30 to 40% in stock prices of different life insurance companies. So that's, again, one interesting area that we've basically focused on. So it's largely been financials, which had faced the brunt of the massive sell-off. But clearly, I think this sell-off and the shave off has created a very, very interesting long-term investment opportunity.
Nilesh, the US economy is going to slow down. It was running on steroids, or it was running on government support. That is going to be waned down, let me put it this way. Now, why I'm asking you this question, Nilesh, is because if you look at the 2008 experience or the 2000 experience, when US economy historically has slowed down, it has impacted IT companies, and IT outsourcing has got affected in the past. Do you see a similar repeat of that now, that US economy will slow down?
I wouldn't rule it out, though I'm less worried about growth rates in the short term. I'm more worried about the margin outlook in terms of how will margins play out. Because, Nikunj, let's look at it. I think for the last couple of years, IT companies have essentially witnessed some reasonably mid-teens to high teens kind of growth in revenues. And therefore, a lot of IT companies have gone on to a hiring spree. In the process, you tend to, in a way, overinvest, or in this particular case, you may have even overhired, and there has, of course, been a spike in salaries and wage bills, and then, of course, it's back to essentially normalcy. So you will see a lot of software development centers kind of becoming operational, travel costs will come back, and all of that. So margins will surely probably have already peaked, or are likely to peak out soon, and probably sober down a bit as well. So that, I think, is one concern which I have for IT companies. And on top of that, valuation. Then, Nikunj, when sectors do kind of have this kind of outperformance, it's pretty natural and normal for them to shed some of that outperformance. So my view would be that growth would probably, in terms of revenue growth, would probably still be in low teens. Margins could be a bit under pressure. And valuation multiples could normalize a bit, which would result into, at best, the sector just being a market performer and not being an outperformer, which it has been. But having said that, we have to keep in mind that during the slowdown period, softness, there probably would be, one or two odd companies which are very specialized in niches. You could call them a small to mid cap, which essentially might present an interesting opportunity when the sector underperforms or just performs in line with the market. So one has to be, in a way, mindful of the long-term opportunity which is there. But in the short to medium term, I expect the sector to be at best a market performer.
Good morning, Nilesh Shah. This is Nayantara. A couple of weeks ago, you did say it's good to take cash off the market so you can deploy it when things start to look more stable. I would imagine this is that time now. You've talked about IT, you've talked about financials. My question is a little basic. The safe havens, the rotation that we had seen towards the value stocks. Is that the way you consider the market moving?
It looks like essentially is that it's going to be across the board. What I see is that a lot of growth stocks have come down to very reasonable prices or reasonable valuations post the recent shave off. So that continues to be an interesting opportunity. Within the value pack, maybe a couple of areas that look very interesting. One, of course, is the entire real estate pack. What I clearly believe is that the real estate sector is going to come out of a very long period of underperformance. And the next few quarters or the next few years look very, very interesting for the real estate space. So I would probably call that or club it as part of the value kind of category. So that's one. Two is a lot of the financials, especially the next level of banks, they have essentially also corrected quite a lot. And to me, probably some of them are now come into a value zone where they probably trade around their adjusted book value, or probably a bit small premium to their adjusted book value, but are creating interesting opportunities. And some of these positions or stocks, which you call them as value, end up becoming also growth stocks, say, in the medium term. And that's essentially the value discovery cycle, which probably investors can ride over the next few quarters or over the next couple of years. So I'd still say that it has to be a combination of growth and value, provided, of course, growth is at a reasonable price. And of course, where in value, you believe that the fundamentals are unlikely to deteriorate further. If at all, fundamentals are likely to only improve, which could lead to their potential re-rating.
So Nilesh, can I ask you, when you talk about the new age companies, the growth companies, hyper growth companies looking more reasonable today, which ones specifically? We've seen the price action on Paytm. Look what happened with Paytm and the comeback that started yesterday. Zomato, which fell below the IPO price. There's been an upgrade that's come in for an Info Edge India as well.
Yes, so the new age businesses, again, I think look extremely interesting. I'd probably say that this pack looks very compelling, especially post the shave off that we've seen, after their listing highs or from even their IPO prices. This is a space we've stayed away from post October or post the listing of some of these IPOs. We stayed away from that. But in 2022, we've essentially initiated a position in PB Fintech, which essentially is India's largest online marketplace for insurance, as well as for personal loans or unsecured credit. So that to us looks now extremely attractive. It's more than half from its post-listing highs. It's at a discount to its IPO price. And the long-term opportunity to me is very structural, very compelling. The only thing that in these kind of opportunities, you necessarily need to have a long-term horizon. You can't be dealing with the next 1 month or 1 quarter or 1 year. You probably will have to think like a private equity investor and be there at least with a 4 to 5 year horizon. Any horizon shorter than that may not be sufficient enough for you as an investor.
Nilesh, what happens to the crude sensitives? And especially, I'm talking about paints as a category here. I know the larger debate is about the valuations that some of these paint stocks quote at. But that said, after the recent correction, with the bounce back in oil, although it's still pretty elevated around that $100 per barrel mark, is this a segment that you would gravitate back to?
We'd still be on a wait and watch mode because, clearly margins for the paint companies are going to be under pressure. No way are you going to be able to entirely pass on, the spike in crude oil prices. With crude at $100, it's going to be hard to sustain your past margins. They're going to be softer and probably will even trend a bit lower. So that to me is a challenge. The other big challenge which the entire sector faces is basically, new entrants coming in. Of course, these are all going to be relatively smaller players initially, but I wouldn't be surprised if the leaders in the paint segment do not indulge in price hikes so as to basically keep off competition and things of that kind. So you're going to see heightened competitive intensity come in, and you're going to see a lot of the incumbents exercise a lot of tactical strategies, particularly around pricing, which may hurt margins further. So I think challenges on two fronts, both the two C's. One is crude oil, two is competitive intensity. These two continue to be challenges, and therefore right now still would want to be on a wait and watch mode for the paint sector.
Sure. Nilesh, also does the entire specialty chemical trade return back, and do you buy more of the same, if at all you buy into these stocks? Because they've had a great day in the sunshine even pre-COVID times.
Absolutely. I mean, this is a very interesting space. We really like the specialty chemical space. In a way, it's a global outsourcing opportunity, which the specialty chemicals sector is currently enjoying. They're currently witnessing strong tailwinds in terms of demand. And therefore, I clearly believe the medium to long-term prospects are very, very interesting for the specialty chemical sector. Just that, Aisha, over the next 1 or 2 quarters, there could be some pressure because real life businesses, on the ground businesses, essentially don't tune themselves on a daily basis to the new reality. So I clearly believe the specialty sector, chemicals as a sector, will face margin headwinds over the next 1 to 2 quarters. I'm not necessarily saying that the margins would be lower, but there surely is a case for margins to be lower. And I think there is uncertainty for the next couple of quarters on the margin front. We really don't know how margins will exactly play out over the next couple of quarters. But over the medium to long term, there is clearly a value proposition which Indian specialty companies have to offer to global players. And that strategic advantage is deeply embedded. It remains. And therefore, the sector, I think, is a great medium to long-term investment opportunity.
Just scanning through the charts right now, and what is popping up on my screen is actually Trent, and that's very interesting. Why? Because by any yardstick, if I look at Trent is one of the most expensive stocks. You've got DMart, which is also making a comeback. Aditya Birla Fashion, that's also looking okay. You've got Arvind Fashion, which is also making a comeback. Nilesh, is there merit in saying that, look, this is going to be that year of normalization? Everybody will realize that, hey, we need more clothes, we need more shoes, we need to travel out, we need to meet more friends, we need to look better. Is there merit in buying retailers, especially fashion retailers?
Yeah, totally. I clearly think that what's really happened, Nikunj, is that if I were to kind of look at it, 2020, I mean, when COVID came in, I think 2020 was a great year in terms of consumer staples. People just essentially probably sat at home and consumed more of these consumer staples and snacking and all of that. 2021 was essentially when, towards the fag end, a lot of buying came in terms of either the marriages which had got postponed and a bit of travel which came in. But this probably happened more towards the end of 2021. I believe that is going to spill over into 2022 and 2022. You're going to see a lot of buying coming in, renewed buying coming in, or restocking by consumers in terms of apparels and footwear and some of these to do what we call as basically the fashion category. So that looks very, very interesting. And post that, what we see is basically demand coming in strongly for consumer appliances, given that they've have had a weak couple of years in terms of demand. It's likely that probably sometime later in 2022, you're going to see consumer appliances again, enjoy tailwinds coming in from renewed buying. So you're seeing a bit of circular rotation, which has really been happening in the entire overall consumer pack. And that's something which is likely to continue maybe at least for another year or so.
Nilesh, you've discussed private banks. You think they've oversold, they will come back. But let's look at the other side of the market. Because of COVID, we saw a complete change in terms of digital adaptability. The world was forced to digitize. Post this entire geopolitical crisis, everybody is talking about energy self-dependence, energy atmanirbharta. How should one align with that theme? Clean fuels, EVs. Is there anything which you think could be a pure play? Because the Europeans are saying that we need clean energy. Indian government is working towards that. American administration is also working towards that. Every crisis realizes us something, and this time this geopolitical crisis has told the world or administrations that they need to be dependent or they need to be self-dependent when it comes to energy needs.
Absolutely. If I were to kind of currently, look at India and the investment landscape in terms of investment themes, there's obviously one to do with basically India's demographics, which is around consumer. The second essentially is around digitalization. The third one, essentially, which again is as powerful, is decarbonization, which revolves around how do you basically move towards carbon neutral and how do you create alternative sources of fuels and that kind of stuff. Within that, we've been playing it through two kind of sectors or two positions. One is essentially through a company called Hitachi Power, erstwhile ABB Power Products. We clearly believe that they are creating several solutions which are hugely relevant for India's energy sector, India's power sector. So that's one interesting kind of way to play. And of course, they have solutions around mobility as well. So be it energy or mobility, Hitachi Energy clearly has essentially solution offerings for their clients. The second area, which again, or second name, which we find interesting, which of course has been a bit under pressure over the last 1 month, is Tata Motors. Obviously, auto as a sector has come under pressure with the spike in crude oil prices, but we clearly believe that Tata Motors is not just a core auto kind of story or an opportunity, but it's also basically an EV strategy. Of course, the core businesses of commercial vehicles and the conventional passenger vehicles, of course, is where they're holding market share or gaining market share. And of course, it's doing very well for them. But clearly believe that Tata Motors is one name which is at the forefront of this whole shift towards electric vehicles. And within that, they already have their products, which are going into the market. Response has basically been good, and that's basically a segment which is likely to grow very, very strongly for them. And I think it's one name which clearly has an EV strategy which is getting executed really well out there. So we find that extremely interesting. So we are playing the entire decarbonization opportunity, through some of these names.
Are you still holding on to your old favorites, Cipla, Engineers India? It's been a while we haven't spoken about your old favorites.
Yes, so Engineers India is something which we basically exited, quite some time back. It's been a while since we exited Engineers India. Cipla, we continue to own Cipla. We continue to like what they do, their leadership, especially in the respiratory segment. And within the pharma pack, Cipla has been a strong outperformer. I mean, essentially, despite the market correcting, in fact, Cipla was actually making new highs. So to that extent, I think the market is vindicating Cipla's medium to long-term potential. So we continue to like the pharma space, and within that, Cipla clearly is one of our top favorites.
All right, Nilesh, appreciate your time and greetings for Holi season once again, and thank you for joining us.